Welcome, everyone. Thank you so much for joining us today. For Home Buying 101, we have Sal, Gary, Randy, and David joining us today. And Sal, I will hand it over to you.
Grace, thank you so much. Good afternoon, everyone. Thank you for joining us for this presentation. My name is Sal Murguia, Partner Development Representative with Wescom Credit Union. I'm being joined with my colleagues today, David Bochter, who's going to be supporting and monitoring the chat and helping our presenters answer any questions that may occur throughout this presentation. And I'm also joined by Gary Hernandez, the Director of Real Estate Loan and Originations with Wescom Credit Union, and Randy Castaneda, who is the Mortgage Loan Originations Supervisor. So we welcome you to being here. Thank you for spending your lunch hour with us. I'm going to jump in a little bit and discuss a little bit about why Wescom is here to do the presentation with you. Can everyone see my screen okay? And are we all good with the screen?
We see the blue a window screen. We don't see the presentation.
Okay, let me try this one more time.
Sure.
Again. We love the Zoom technology. It allows for all this technical stuff. Okay, so let's share screen. Now can we see the bear?
We can see the bear.
All right, here we go. Thank you, everyone. So let's just join in for Wescom Credit Union. All right, better banking for Bruins. So Wescom was established in 1934. We are a credit union that's one of the largest in Southern California. Credit unions offer similar products and services that you'd find at a bank, but like other credit unions, Wescom is a non-for-profit cooperative, meaning that the profits that we make by law, we have to give back out to our membership, and our members will save money in a more general sense through the form of lower fees and lower rates. We have 24 Southern California branches to serve you. So if you're not on the UCLA campus and you're working remotely, or if you're out living in an area throughout Southern California, you can always visit our website and look for a branch that's near you. So Wescom Credit Union and UCLA joined in partnership about 5 years ago. So Wescom is here to build better lives for Bruins. We are the official banking partner of UCLA Athletics, Campus Life and Recreation, the Alumni Association, and I'm proud to say that we're a proud sponsor and partner of Staff Assembly. So with that, we want to be a resource for the entire Bruin community, including students, alumni, faculty, and staff. In that support, we're here to help you as a Bruin create financial healthy habits, and we want to make banking easy for everyone in the Bruin community. One thing that I would like to promote and offer to the UCLA Staff Assembly members here today is our new partnership with UCLA's Affinity Card program. UCLA and Wescom has their own Visa card where it has a 0% intro APR for 6 months. You get 50,000 points after $2,500 spent in the first 3 months. You get a 1.5 points for every dollar spent and 5 points per $1 at these various UCLA vendor locations. So that includes ASUCLA campus restaurants and dining, athletic tickets, special event tickets, Poly Pavilion concession stands. So get this card if you're on campus, especially use the card on campus. You'll get 5 points per every dollar that's being spent. So I just wanted to share that with you today. Along with providing these types of lunch and learns, we also have our Wescom Financial Services and a Wescom Financial Advisor that's exclusive to the UCLA community. Our Wescom Financial Literacy Advisor that's assigned to the UCLA audience is Carl Gerstenacker. He's a UCLA alum himself. And if you're looking at, needing some advice or want to discuss your financial situation and look at perhaps growing your money, looking into retirement, things of that nature, please feel free to make an appointment with Carl at his email address that's listed and at the 888 number that's listed on the page as well. His extension is 1239. We have our Wescom campus branch that's open Monday through Friday from 10 a.m. to 5 p.m. It's located on the first floor of Ackerman Student Union. You can stop by and say hello to Martha Prado, who is the branch manager, and her friendly team at the Wescom branch, UCLA branch. And you can always go there to access the ATM, exchange some coins at our coin machine, or if you're looking at just asking questions, or if you want to open up an account with Wescom, we're there to serve you. So today we want to advise all of you to participate in this conversation. A lucky participant who participates either in the chat or will open up or ask any questions and engages with our presenters this afternoon will be entered to win for a $50 UCLA store gift card. So good luck to all those who are going to participate in this, and we will be happy to reward the lucky winner. But with that being said, before I move on, you can always contact us at our website at ucla.wescom.org, and you can always reach out to us at our 888 number, 888-493-7266. So I just want to say thank you. And as I stop with my share screen, I'm going to turn it over to our featured presenters, Gary Hernandez and Randy Castaneda. Take it away, gentlemen.
Right. So let me get this set up and ready to go here in slideshow. All right, and let me see when I share my screen. All right. And I'm hoping you guys see the Wescom to Wescom home financing basics for UCLA Staff Assembly presented by Wescom Credit Union. Today's March 3rd, 2022. I can't believe it's March already. March Madness, and UCLA has a wonderful opportunity here with their basketball team to make some damage here this month. So I'm sure all you guys will be watching. I'm definitely a UCLA basketball fan. My name is Gary Hernandez. I'm the Director of Loan Originations, and we're also going to hear from Randy Castaneda. He is the supervisor for the Originations team, and together we help support the mortgage loan officers that would be able to help you folks out there. So with that, we'll go ahead and start. And Randy and I are going to be co-presenters today, and I'll take on the first kind of question is why should you buy? I'm sure you're out there wondering, first of all, why should I buy? When should I buy? What's the process? And how do I go about that? And what can Wescom do for me? So we're going to look to answer all of those questions today. And again, as Sal had stated, thank you for taking your lunch hour to spend it with us today. And I think you'll be glad you did. Okay, so why should you buy, right? So there's what's called pride of ownership. It's just when you own something, you look to take care of it. It's something that is a goal of yours, and it's called pride of ownership. And what is very interesting is the rate environment today. Rates are still at historic lows. So when I say historic lows, I'm looking back 40 and 50 years. Although in the last 45 days, rates have increased, but still at today's levels, they're still very attractive rates. Okay, so we'll talk a little bit more about that later in the call. Why should you buy? Again, stable housing costs, your monthly cost versus rising rents. So when you are able to purchase a property and you secure a rate, and mainly a fixed rate, then you know what your monthly payment's going to be every month, right? Taxes and insurance, they vary slightly year to year, but all in all, you can count on knowing what your housing expense is every single month. If you're renting, that's good for the length of your lease or your rental agreement. So over the last 10 years, rents have skyrocketed. And I know that if you're renting out there, you can feel it. And that's why the amount that you pay in rent reach out to, Wescom, and we can take a look at seeing what that monthly rent payment could afford, what type of home you can afford with making that same payment. Another reason why you should buy, there's a gain in equity as property values continue to rise. And UCLA and we are in Southern California, so more people are coming here every year, although we've had quite the exodus over the last couple of years with the ability to work from home, and you really don't have to live near the job. And so that phenomenon is occurring right now, but we still have this lovely Southern California weather, and people around the nation, let alone the world, would love to live here. And so that's why the property values continue to rise or become very stable. Gift money can be used. So obviously, when you are looking to purchase a property, you need money. You actually do need money, or you need a loan, you need financing. And another way to be able to get into a home is gift money can be used as a down payment. So if you have a close relatives, immediate relatives that have that flexibility to lend you money, you can use that as down payment or assets for a loan. A leveraged investment, this is my favorite part here. You could put down as little as 0%. We have that program. You can put down as little as 5%. We have that program as well. The greatest thing about it is you get it when your property value goes up 10%, you gain 100% of that 10%. So if you put down 0%, you qualify for that. The home you buy is $600,000, and then next year it's worth $660,000. Although your loan is still, just under $600,000, you have the equity difference between the value of $660 and your loan balance. So a leveraged investment. There's not too many investments out there where you can borrow and invest, and this is one of them. And then you should always check with your tax advisor, but there's potential tax benefits, interest paid, and then if you get into investment type of properties, expenses, but consult a tax advisor. So those are some pretty good reasons on why you should buy. And the next slide, I'm going to let Randy discuss a little bit about, are you ready to buy? So Randy, take it away, sir.
Yeah, thank you. And thank you everyone for joining us today. A lot of good information, so let's jump right into it. So to piggyback off of Gary is, are you ready to buy? So we want to look at the 4 C's of credit that lenders do consider. 4 C's are going to be your credit, your capacity, your collateral, and then cash/assets. Okay, we'll go into a little more detail, but for right now, just to kind of give you a general ballpark. Questions you kind of want to be asking yourself, do you have a history of paying bills on time? Because that strengthens your credit profile. Do you have a steady income? Is that something that you can show that you've been at a employer or a job for a reasonable length of time? We'd like to see at least a 2-year history. Some variations of maybe a 12-month could be considered. The property condition, does it meet a minimum standard? Now, we do underwrite to Fannie Mae guidelines, which does have its own conditions and requirements for the certain property types. Okay, and again, we'll go into those later. Money for a down payment and closing cost. Okay, those are often something that we do miss in trying to do a sort of when we do a transaction. We want to make sure that we're also considering the closing costs on top of the down payment. Okay. And then your cash reserves, in the event life happens, a situation may occur, are you able to still maintain that mortgage payment? So that's kind of the initial questions you want to start asking yourselves. And then, of course, that basically equates to you being able to demonstrate the ability to repay a mortgage.
All right, great. Thank you, Randy, for setting the table there, sir. This next slide here is the keys to home ownership. There's 4 main keys to home ownership, and we're going to go over each one. Randy alluded to this one. Job stability. The lender needs to know that you have a stable source of income. Credit history. Credit history counts. If you've had challenge with credit history in the past, it's not the end of the world. but better credit obviously gives you better opportunities. Cash to close, you need some type of cash to close. Even if you qualify for a 100% program, there's still closing costs on top of that. And so there is a requirement for cash to close. And then of course, income. There's multiple types of income and multiple types of documentation to support that income. And we'll go a little bit into that. Turn over back to Randy.
All right, so let's go a little further. And as I mentioned, key number one to job stability. Again, salaried or paid hourly. 2-year history is required. Some exceptions could be made with a little less duration, but case by case. Self-employed is a 2-year history. We would like to take an average of any self-employment income just to make sure we have a solid baseline. Your second job, seasonal, part-time job, those are all okay. We do require a 2-year history, and again, possibly 1 year with an exception. Moving from companies, depending on the situation, that might be okay as well. Being within the same line of work is extremely helpful because it tells lenders, hey, you might be moving up, in your position or your role, but you're still within the same line of work. That's okay. Okay, those can often be bridged from one employer to the other if there are similarities. Employment gaps. There has been recently with the pandemic, there was employment gaps that we were able to kind of bridge, for obvious reasons, but we do take a lot of that into consideration as long as it makes sense. Again, pandemic was affecting a lot of individuals, but in that duration, we were still able to accommodate quite a few members to meet their goals and needs. Okay, so those are some of the things that we do like to look at. Overall, again, these aren't hard rules, but they do have to make sense in the grand scope of things. Okay, and that's why we want to make sure and give as much information as possible, so that way you have a good solid baseline.
Great. And then also just another comment on the different companies. The example of what Randy had stated is you just don't want to jump around with different job titles or different types of work. Again, company to company to company, if you're doing similar type of industry or job, then that's more stable than going from a general contractor to an accountant and then over to some type of sales. That would be kind of in the underwriter's mind not as stable, and so that could work against you. But if it's the same line of work, then to Randy's point, you're just moving up, looking for opportunity, and that's better your situation. All right. Next slide here. Key number 2, credit history. As I had alluded to, credit counts, right? It makes a difference. So when you're looking at your credit, do you know what your credit report looks like? So, you would want to be aware of what is on your credit, right? And, things that are on your credit are things such as, monthly payments, credit cards, auto loans. Things that are not on your credit are like cell phones, utilities, cable, things of that nature. They're looking for revolving type of accounts or installment type of accounts to grade on how you repay. Okay, so that counts. So an example, you got to do what you got to do to make your monthly payments. An example would be, everyone gets those 0% interest rates for 9 months or whatever. If you need to and you're short on cash for that month, if you need to borrow from one to pay the other, you need to do that. You need to stay on top of your monthly payments. Okay, so make sure you're doing so. Do you have a budget and do you stick with it? This is one of the key things at preparing yourself to be, a credit worthy for future loans, whether it be additional credit cards, auto loans, or home loans. You should have a budget and you should stick to it. This will allow you to list everything that you spend your money on a monthly basis. And as you go through the month, as long as you're within that, you don't have to stress, you don't have to worry. It's already budgeted, it's already thought about. And then you'll be able to identify costs and expenses that are not accounted for and that you need to, figure out on how you're going to handle that. So again, having a budget and sticking to it is key, right? Again, have you paid your bills on time? Got to make sure, again, like I had stated, you got to make your bills on time. Because if you have late pays, that's telling every creditor, every future creditor, that you may not be as good as a credit risk as you're alluding to. And I know that we have a question there from Juan. And Juan, go ahead and use the chat at this time so we could get your question. And then as we look to complete some of these slides, we'll circle back, okay? How much of the credit line in use? So if you get a credit card and say, for easy math, say it's $1,000 credit line, right? And so, yeah, you can use a credit line, you're approved. But if you max that out right away, 900, 950, and then you get another credit card, $3,000, you max that out right away. It's telling lenders that, hey, this person's looking for credit and they have a need for credit, but they're using it right away. That could be risky. So the kind of a barometer, if you will, is kind of a 3,000 or 30%. I guess I'm sorry, a 30% of the line limit. So if it's $1,000, then maybe a balance of about $300 is where you would want to be. If it's a $3,000 credit line, maybe around $900 balance is where you want to be. You can use the $2,000, $2,500 off that line, but have a plan on trying to get it and manage it to about 30%. And that would show creditors that you can not only get credit, use the credit, but keep it at a reasonable level, okay? And that's that, how much do you owe? If you owe 30%, you're in line. How long accounts have been opened, right? So the longer you have an account and you have a long pay history of paying on time, that adds to your overall credit score. So you want to make sure that, even if you have a zero balance, don't close it out and don't leave it inactive, right? You want to use it, right? And so here's an example is, I have a couple of credit cards that I use. One I use for everything like groceries, gas, anything that I'm paying monthly. And then I pay that off every month. Instead of using cash, I use a credit card. I don't care what the interest rate is because I pay it off every month. So I'm not really paying interest on that. So, but what I am doing is showing creditors that I'm using the line and paying it off every single month. So you'd be using cash for gas and groceries. Why not get credit for it? Another credit card I have is I carry a balance on it. If I can't pay it off every month, it's a credit card that I go out and look and find. And your Wescom branch could help you find a credit card, right? There's multiple types of credit cards and they can help you with that. So I have a low interest rate credit card that I use in case I can't pay it off every month. Then I keep that balance on that credit card. Okay, so again, there's multiple types of credit cards. And then the last thing about credit history is public records. I call this life happens. Things occur, right? That either you don't see coming or certain circumstances, force you to make different decisions, such as, filing for bankruptcy. All of a sudden you have a judgment because you couldn't settle or pay that off, or something went into collections, or there's a foreclosure on a property, or you have tax liens. Again, all of those don't preclude you from getting a loan, but all of them have a timeline, that a history that we like to see that you show after these instances occur, to show that you are back on the right page. So all of those are individual situations that we'll review and see what options you might have. Okay, so that's the credit history. Key number 3, Randy.
Okay, and key number 3, cash to close. So I know there's some questions about what do closing costs typically run, So we can kind of go over that now. So down payments, and Gary kind of mentioned this previously, is that we do have 100% financing. Now that's a Wescom specific product. And if not 100%, if you have a small down payment that you want to leverage, we can utilize 3% for a down payment as well. But again, you have your 0 to 5% minimums. You no longer need 20%. Again, if you have it, even better. But if you don't, we do have options for you. Okay. Closing costs. They're typically around 2 to 3% of the purchase price. There is some variance depending on the exact location of the property, but a good estimate is going to be around 2 to 3%. The good news is also we can leverage gift funds or even equity. So maybe there's a transaction where someone's willing to gift you funds. There are requirements when receiving gift funds. Typically, it's surrounding immediate family members that can offer a gift fund to you, or equity. They may be able to offer a gift of equity if the property is being sold to you. That is always a strong possibility as well. Of course, reserves. Doesn't have to be anything liquid. It could be in something else, such as a IRA, any sort of share stock market, or just any other liquid that you possibly are leveraging. Those can be used as reserves. Typically, our minimums are around 2 to 6 months of your principal interest, property tax, and homeowners insurance. More cash reserves could be required depending on the loan product and the conditions surrounding the loans. But again, we try to keep them fairly reasonable. So 2 to 6 is kind of your baseline. Some do require up to 12 months. Again, depending on the loan program. Now, this is where a lot of members do kind of think that they can't qualify. But if you look at it in all consideration, a 0% down payment and 2 to 3% closing costs, that's not a lot of upfront money to put towards a property. So that gets you in. And then, of course, Gary mentioned if that property starts building equity, the little bit that you had already put in, well, now you're capitalizing on the increase of the equity that now you're gaining. So it almost behooves everyone to try to leverage, maybe considering purchasing property if possible. Again, I know everyone can't do it immediately, but there's the silver lining is eventually, with the right motivation and the mindset, and of course, the right lender, you'll be able to achieve that. Okay, so these are things that we want to make sure and inform everyone that it is possible. Again, 20%, that was long ago. It's no longer the case today. And with Wescom's products, again, I like to highlight the 100% financing. The only requirement on that, just to kind of get ahead of it, is you'd have to come in with 1% of your own funds plus the closing costs. After that, as long as you qualify and you meet all the other ratios, you can go shopping at any point. If not, secure the property that you've been looking for. Okay.
All right.
Gary and Randy, there's a couple of questions related to the cash to close. Do you want to talk about those now, or do you want to go through the slides and touch base at the end?
Yeah, I was just going to comment on these are great questions, and this is what it's for. And we'll go ahead and stop here, David, and answer a couple, and then we'll wait for the rest of the presentation, because I think that some of these will be answered in the presentation. And we're doing good on time, and we'll have time at the end of the call. And so a couple of them in here is yes, if you're putting, less than 20% down, you do have to pay mortgage insurance. But there's a couple of programs, the 100% and the 97%. So you put a little down. Wescom has special programs that have discounted MI. So yeah, although you put down less and you'll be required to pay this mortgage insurance, we even offer discounted mortgage insurance to help you keep your down payment low and get you into the home and get you a discounted MI piece. And then after 2 years, you can apply to have that MI removed if you have equity position of at least 20%. And so that's how that piece works. Other questions here. So there was that question, 20% down. So that was Jeffrey's. And yes, Caitlin, it does offer a higher payment. So the higher your loan amount, the higher your payment's going to be. But at times, as long as you can qualify for that payment and it's in your budget, then you're into the home. Then you're a homeowner. And then what Randy had talked about, you start to enjoy the equity as it grows, right? Closing costs, Samantha, it's on this screen, 2 to 3% of the purchase price. So if you're a $600,000 loan, anywhere from 12 to 18,000 in closing costs, which is taxes, insurance, appraisal, depends what your loan that you selected, home inspection, things of that nature. Okay. Is there any other questions, David, that you saw in there? I have one other one. So this is your question earlier, sir, in regards to if you have a good credit score and you're making higher than minimum payments, it's going to definitely not impact your score negatively. It'll be looked at, positively. So again, make monthly payments. That's the first key. And if you can afford to make more than the monthly payment, that's going to help with the interest that you're charged and your overall credit score. Okay. How do we provide proof of our reserves to lenders? That's just asset statements. So it depends on what type of assets those are. You just get 2-month statements, and then we can review those. There's many types of assets. So we would want to have a discussion with you and see what those are. Okay. And then there's a question about property on a trust eligible as equity. So that would be another unique situation. We just have to kind of have additional questions to understand what that is, but that could be an opportunity there. So we'll go on to the next slide here. And if there's any other questions, David, in there that I may have missed or highlighted, we can pick that up in the next break. All right, the last key number 4, income qualifying. Randy touched upon this. So depending on the type of income you have, right? You can have a job as a W-2 wage earner. You can be paid hourly or salary, and then that's one way to earn income. On top of that, if that job offers you overtime, a bonus, or even commission, then we can allow that type of income as well. But overtime, bonus, and commission would be considered variable income, and we would need a 2-year history. Okay. Randy touched upon this a little bit earlier. Second, seasonal or part-time employment, we can also include that to help qualify for your loan. But again, a 2-year work history is required because we want to make sure that we know we can work your day job and your second job as well for 2 years. That'll give us an indication that you're able to do that going forward. Okay. Then other types of income, retirement income, pension, Social Security, we absolutely count that as well. And just an award letter would be helpful for that and a life benefit. Disability income as well. So we take a look at that. There's multiple types of disability, short-term, long-term, again, unique situations, but generally 3 years of continuance. We review that. Self-employment, again, 2 years tax returns would be required mostly. At times you can get away with the 1 year history, but generally we're looking for at least 2 years self-employment. And then another way you could qualify to help your situation is if you had someone that could be what's called a non-occupying co-borrower, someone else that would put their name to your transaction, and they would be liable for that debt as well. So they could, a parent or someone else that would want to help you out would apply with you and would be part of the eligibility equation. Okay, so I hope that gives you an indication of what type of income and what type of documentation. Next one, mortgage products, Randy.
All right. So now that we have the keys all established and everyone has at least a good baseline on what lenders may look for up front, now let's look at some of the products that Wescom does offer. We do lend in all 50 states. Texas is one of the only ones that we do purchases, at least at this time. But all the other states, we do purchases and refinances. We do underwrite and offer conventional loans per Fannie Mae. We do have our portfolio products, specifically the 97% and the 100% LTV programs. Again, I can't stress how rare it is to find a program that offers that kind of flexibility. Oftentimes, I get questions from members who can qualify for a little higher payment in lieu of having a lower down payment or no down payment. So the trade-off is not having to wait too long to build up this down payment. If anything, you're in the house now. And of course, the catch is you want to be able to cover, a little larger payment. So I think there was a question alluding to that as far as, if you do put down a lower down payment or no down payment, are the payments monthly going to be a little higher than usual? Sure. I mean, but again, there's the trade-off. You're in the house right away. You're not having to wait, however many months, years, or whatever the case may be to get into the house, because that allows the flexibility to move in, sooner than later. We do offer loans up to $5 million in a single loan or in an aggregate. We offer investments, 1 to 4 units. Second or vacation homes are okay. And then home equity lines of credit up to, and this was a recent change, 90% of the loan to value. And that's, of course, based on certain conditions. But the HELOCs, home equity lines of credit, are restricted to California properties.
Great. All right. Moving right along here. Debt to income ratio. So debt to income ratio is an eligibility requirement, and it's a math equation, and it tells the lender, what your debt to income ratio is. It's a number that tells you how much of your gross income is committed to debt. And so a nice kind of sliver here would be anywhere from 41 to 49% is kind of the sweet spot. 43 to 45% are those Fannie Mae loans, which is a secondary market outlet for loans to be purchased. And up to 49% would be the Wescom portfolio products that allow you a higher loan to value. And so again, Randy touched upon that a little bit. Not only does our portfolio products offer a 97 and 100%, but they also offer adjustable rate mortgages, which are becoming a better option in this rate increasing environment. So as the fixed rate continue to go up, we still have adjustable rates for a different, fixed periods that could fit right into your plan. So your mortgage loan officer would want to have a conversation with you. Yes, a 30-year fixed rate, you hear it on the radio, that's great to have. But if you're not going to be in the home for 30 years, you're going to overpay. So if you are going in for your first home, maybe you're going to be there 5 years, 7 years. Maybe a 10-year fixed is better for you and offers a lower rate, which is a lower payment, right? So that would be an option. And those are portfolio products. So again, debt to income ratio is your housing expense, which includes your mortgage principal and interest of the loan. And then, every property, you got to pay Uncle Sam the taxes. And so property taxes are included in the housing expense, as well as homeowners insurance. So when you own a home, you have to have insurance in case it burns or there's something that occurs on your property. It's a requirement of the lender. And if a lot of the times there's more homeowners associations now, even on single family residences, because they have shared common amenities like pools and clubhouses. There's also security measures and street lights and in parks and things of that nature. So that's part of your housing expense. So think about that. If you're out shopping for a home, if it's in a planned urban development, there's going to be additional monthly fee as well. And then if you're in a flood zone, so there's some parts of Southern California that are, in a flood zone, then that would require you to get flood insurance. And then earthquake insurance is optional. Okay, that would all be your housing expense. And then on top of that, any other expense, right? Auto loans, credit cards, student loans, any other type of revolving debt or installment loan, as we touched upon, and that's all included. And Randy's going to go over an example of how we get to a debt to income ratio.
Yeah, and before diving into the debt to income, I want to circle back on something Gary had mentioned. There are often times when I'm asked, when is it a good idea to take an adjustable rate mortgage? And Gary did kind of touch on that a little bit. And that's to kind of benefit you to initially try to qualify for the payment to get you in the home. Questions that come out of that are typically, well, when is the right time to refinance after I take the adjustable rate mortgage? Or how do I know the interest rate's not just going to jump up on me and all of a sudden my payment doubles? Again, all good questions, but let me kind of put that at ease. This is why we have loan officers to monitor that for you. So again, the relationship is always established from the beginning. We do want to make sure we partner with every member and have their best interest always at the forefront, even if that means watching rates for the next 6 months, a year, 2 years, 5 years, 10 years, whatever it takes to make sure that you're protected from a random increase in payment. We're going to be monitoring that for you because we do have in-house programs that kind of helps us give us some visibility, but also to make sure that we have your best interest at heart. Okay. So I just wanted to circle back on that real quick.
Great. And then Randy, real quick, Walter had a question in regards, what do we offer a veteran loan right now? So right before the pandemic, we were offering VA loans and FHA loans, but the pandemic, we're not a direct endorsed FHA or VA lender. So when the pandemic kind of occurred, those outlets just were only dealing with direct endorsed VA and FHA, but we still have the 100% Wescom high loan to value. And that's mainly, the biggest benefit for a veteran is to get 100% financing. So we still offer very comparable products to that. So I just wanted to answer Walter's question. Go ahead, Randy.
Okay. Debt to income example. So, and again, in this instance, we're going to see how we calculate and pretty much how lenders are going to look at it. So mortgage payment, we're having estimated $2,850. Credit card A, $100. Credit card B, $150. Your student loan payment per month, $200. And then you have 2 auto loans, $425, $575. Gives you a total payment due to lenders of $4,300. Now, what will happen is lenders will take your gross monthly income. In this example, we're assuming someone's bringing in a collective $10,000 a month gross income. We take your expenses and then pretty much tie that into your income, and we come up with a 43% debt to income ratio. 43 is your solid baseline. Now, is that the hard number? No. Gary mentioned that we do kind of tend to go up as high as maybe 49 at times, depending on the program, but therein lies the flexibility. But if someone ever wanted to know, well, where should I be? 43 is a good jump off point because that kind of gives you the flexibility to either go a little bit higher, or maybe if you go lower, that increases your buying power a little bit. So again, there are trade-offs and everything does move in opposite directions should something change. So again, this is also a very good starting point, in running your own scenario. It already kind of gives you, okay, if I had all these monthly expenses, but my income is this, well, there you go. You qualify based on a 43% debt to income ratio.
Great. And we're about 14 minutes of the hour, so we'll go ahead and go through these slides. We can save a little bit of time at the end. So there's other third-party participants. So you don't only have your lender involved when you're purchasing a property. There's so many. There's got to be, 40 different people that actually participate, from underwriters to processors to appraisers. And here's 3 main participants. The title company, what do? They ensure that the property is properly owned by the sellers. You want to be buying from someone that actually owns the property. So that's what they do for you. Ensures the liens on the property are paid off. So after you buy the property, they make sure there's no one else that's going to knock on your door after you finish the transaction. And then they also ensure that the new owner and the mortgage holder is holding title to the property. So when you get a loan from Wescom, you buy the property, they pay off the old one, and then Wescom is on the title, and then you're good to go. Escrow is like the referee. They're the ones that aggregate, they put everything together and they follow the instructions. Okay, so they don't work specifically only for you. They work partially for you, for the seller, and for the agents, and for the lender, right? Acts as a disinterested third party that protects all individuals in the transaction. They collect all the money, the down payment, the new mortgage funds, and then they complete the signing, the closing, and then they pay everyone off. They pay the old mortgage company, they pay your taxes, they pay the insurance company, they pay the agents. They are the ones that disperse, right? And then another big participant is the appraiser, right? They inspect the property and the terms of the purchase agreement. Then they determine the property meets the zoning requirements and the property is properly permitted for the use and for what it is built as. And then they estimate the fair market value of the property. Market update.
Okay, so recent market update, as again, Gary mentioned, the rates are kind of on an upswing, but with certain geopolitical events and just overall housing market, there's always the uncertainty of, when are rates going to go up? When are they going down? The answer to that is we don't know, but we always want to be, paying attention to them as close as possible in anticipation. So again, rates over the last 2 years, very strong, very low, but we are facing a slight increase. Okay, so doesn't mean it eliminates you from being able to buy. It just means, you may have to adjust a few things, but even that's still subjective. Maybe it doesn't impact you. Maybe if the rate went up, a half a point, it really doesn't impact your eligibility. Now, does anyone want to pay a higher interest rate? No. But, and this is why we watch rates, because again, if down the road they scale back, well, guess what? Hey, loan officers reaching out. Guess what, member? Hey, rates are now favorable. What do you want to do with that? So again, those are always things that we're being monitored, and that's to work for your best interest. It is still a seller's market. There is less inventory, and of course investors, and there is a lot of cash on the sidelines. So sometimes I do get questions about, well, with prices increasing as they did, how can I afford a home? Well, and this is where we always pose the question, have you spoken to a loan officer yet? Because you may not be out of the ballpark. There may be some slight challenges, but definitely not eliminating you from being able to purchase a home. So my answer to that would be always speak to a loan officer to get your options. It's surprisingly how close members are to achieving that home ownership. They just need that little extra consultation from a specialist like a loan officer to kind of get you there. Okay. And then of course, in a transaction, you're always dealing with realtors. It's always recommended to speak to more than one realtor. I know we all have friends who are realtors, and that's okay. But you want to always be on the side of objectivity, because every realtor operates differently. Just like some loan officers operate, they're not all equal. So you always want to find the good fit for you. Okay, so always do your due diligence when trying to consider a realtor, or even again a loan officer. We have several on staff, highly trained, can get you the information you need for the time that you're asking. As mortgage changes every single month, you might have a different scenario. It may be favorable one month, maybe not as ideal the other, but it always changes. Okay, so don't ever think because something's moving in one direction, that's the only direction we're going. So for right now, the market is still kind of on an uncertainty. So again, do your best to kind of look at your options, and then of course reach out and speak to the individuals that could get you the information that you're looking for.
Great. We have a question in the chat just in regards to loan amount cutoff. So the conforming loan limit for 2022 is 647,200. So that loan amount or less be Fannie Mae conforming type of guidelines, and then over that amount, Wescom does offer loan programs all the way up to $5 million. So again, that's the Wescom's portfolio opportunity there. Next slide here is the property search conditions. So you're looking at your credit, you're making sure you're gainfully employed, you're saving funds. Then when you start to think about properties of what you want, you got to sit down and make a list, because once you're ready, and ready means you have cash, you're pre-approved, or you sold your home, that's ready in this market. You can't have a home that's not sold yet, that's not ready, because like Randy said, there's cash on the sideline, you're going to get beat. It's super competitive. So being ready is you're actually pre-qualified, ready to go, you have cash, and we can help you get ready. So then you want to sit down and figure out, where do you want to live? And of course, what's the driver is location, location, location. You really want to figure out where you want to go. That's probably the biggest consideration is the location. Then you start to figure out, are you commuting to work, and what does that look like? Do you have, small ones, or plan to have small ones, right, for school, or even, older kids, or even to college? What does that look like in and around where you want to? Do you need a property that you can walk to, amenities and do things, right? Do you want to be near family members? Some don't. Number of bedrooms and bathrooms, does that support what your current family looks like, or your planned family looks like, right? Square footage, what are you looking for? Is there out space that you need? Preferred location, type of home, a condo or a single family resident, or a condo, a high-rise condo, right? The layout, which way does the door face, and the sun, or does it, do you want to look at the sunrise, or do you want to look at the sunset? The school district, and for you pet lovers out there, is it pet friendly, right? That's important. That's your family. So things to think about.
Okay, and now that you've thought about all that and you've done all the legwork, you've spoken to all the professionals that you've spoken to, now we want to close the real estate transaction. So what does that mean? Okay, offer was submitted, offer's now accepted. Now we're on the clock to make sure we meet that close of escrow, and that's typically between 30 and 45 days. Some are a bit more aggressive than 30 days, could be less than that, but that all depends on how ready we are, as well as yourself. We received the fully executed residential purchase agreement signed by all parties, and then that's presented to us as the lender. We then open up escrow, title is ordered, and the appraisal is scheduled. The appraisal inspection does occur. Homeowner inspection should, again, recommended, because you do want to see if there's any challenges that maybe the appraisal doesn't see. So always recommended to go with the home inspection. Now that we've done all the paperwork, and we've worked on some conditions, now we have lender final approval, if not already. Loan and appraisal contingencies are reviewed by you and the realtor for removal. Wescom does not offer any direction on lifting contingencies. And then you do your final walkthrough, making sure the property is still sound, nothing's wrong with it from the time you originally seen it till the time that you're doing your final walkthrough. And then your loan's funded by the lender, us, and then escrow disperses all the funds to all the involved parties, and then the purchase transaction is recorded with the county, and then you finally get your keys. And there you go. All that, you finally get the keys. And that right there is probably a very good feeling. Being a first-time home buyer, I know it's going to be, challenging, but fun. And that's why we want to do it this way, to make sure and give you the information to empower you to know how things are supposed to operate.
And then just to get started again, part of the being ready is being pre-qualified. So what do you need? So start to gather, if your hourly or salary, 1 month of pay stubs, your most recent 2 years W-2s. If you're self-employed, most recent 2 years tax returns, all schedules. If you have these various different types of fixed income, then you'll need your award letter and or 1099 from last year. And then bank statements for assets. That's a good start, and that'll leverage and give you the opportunity to reach out to a mortgage loan officer, or you can apply online and get pre-approved in little as 15 or 20 minutes, literally. So pre-qualified lets you know what you can afford, right? It shows the seller you're serious. And in today's market, you cannot you cannot even go see a property without being pre-approved. And then as soon as you find a home, you can strike, you can buy, right? And then the pre-qualification is good for about 75 to 90 days. So that's the rest of the slides. I know we're at about 12:57, 12:58 questions, and I'll turn it back over to Sal and David.
Thank you. Thank you for that, Gary. I know that a lot of the questions that were coming in, you know, were really as you discussed through the presentation, you're getting to a lot of the questions that were being asked. David, were there other questions that we may not have touched upon? I know we're up against it in terms of time. I see Angela asking about making an appointment to talk for a one-on-one. Gary, can you give that information?
Yeah, sure. So your rep is Tracy Lopez. And so I think there's a phone number that we can provide. We'll put it in the chat here. And it's 888-29, what is it? 472-7266.
Were you able to put that in, Gary?
Yeah, and then also
Okay,
that's the way. So you reach out to Tracy Lopez, and the first thing is that you'll need to start an application. And again, whether you're ready to buy or not, the pre-qualification will confirm that. If you say, hey, I'm not ready to buy, I just want to see what I could get pre-qualified for, then Tracy would be the one to help you out. Or if you say, I'm ready to go, this will confirm that you're ready to go. So starting off with the pre-qualification, reach out to Tracy is the best bet.
Yeah, and thank you for that, Gary. That's a lot of, you know, that goes for everyone on who's involved in the chat, who are asking a lot of specific questions and Wescom related product questions. And we want to thank everyone for that. And with that being said, I'd want to congratulate our random drawing for the participants who are asking questions throughout the chat. And that goes to Caitlin Hanley. Caitlin Hanley, you're our winner of the $50 UCLA Store gift card. Caitlin, if you could, please, if you can direct message myself or David Bochter, your email address, we'd be happy to send you the $50 UCLA Store gift card. So Caitlin Hanley, you're our lucky winner. And with that, I just want to say thank you to everyone who was involved, and thank you, Staff Assembly, for allowing us to participate in this, and just say thank you to all those who participated in this as well. Once again, please contact Gary and his team and Randy and his team. Thank you both, Randy and Gary, for all that information, and we'll be happy to assist anyone who is on this call with their home buying needs. So thank you so much. Grace, I'm going to turn it back over to you and just say thank you.
Thank you so much, Sal, Gary, Randy, and David. And thank you everyone for joining us. And we will see you in the next Learn at Lunch.
Right. Go Bruins.
All right.
Take care, guys.
Thank you so much.
Go Bruins.
Bye.